So that's one of the reasons why I use an FHA loan in one of those scenarios usually. Okay, a VA loan. Are you veteran? Okay, veteran loans are really good. You don't have to put any money down. You have no thing called PMI, anything like that. Conventional loans, okay, you can go with the conventional loan. You can go with as little as 3% down. If you have 3% down or less than 20% down, or less than 20% down, you have to be worried about a thing called PMI. Have you heard of PMI before? Private mortgage insurance? Okay, so if you put less than 20% down, what's going to happen is the lender's going to want to make sure that that mortgage is insured. So if you decide, you know what, lender, I no longer want this house, well, they're insured for the 20% of it. So they're not going to get burned on the whole. If you only put down 3%, they're not going to get burned for the whole thing. At least they have some sort of insurance, which you've been paying like a premium for each month. Okay? We won't go through the affordable housing program today. Let's go into the terminology section. Okay, so the terminology section, mortgage terminology, okay. Adjustable rate mortgages are ARMs, okay. What happens is that you get a low introductory rate with an ARM, okay. Usually they're in the increments of 1-year ARM, 3-year ARM, 5-year ARM, 7-year ARM, or 10-year ARM. What that means is that for the first 1, 3, 5, 7, or 10, let's just use a 7-year for example. So for the first 7 years, you will not adjust. It stays the same, okay? After that adjustment period, then it can adjust. What happens on an ARM, you have a few things going on there. You have an index, okay? So let's say it's based on the 1-year LIBOR index, okay? You've probably seen that going around, right? LIBOR. So this is just like an index like prime rate or something like that. Could be any of those things. What happens, you have the index, then you have a margin, okay? The index goes up and down, and then the margin is the standard amount, so it's 2.25%. So what happens on an ARM rate, on an ARM loan, is after the 7 years, you have this margin which is 2.25. You'd add that to the index. Let's say that it's remained at 1%. Say it started at 1% and remained at 1%. You'd add the 1 plus the 2.25. Your interest rate would be at 3.25. Whereas if that index went up to 5%, you'd add the 5 plus the 2.25. Your rate could go up to 7.25. So that's how ARM loans kind of work. Amortization, that's just how long it's scheduled to pay off. So usually, most programs like an ARM, it's scheduled to pay off in 30 years. So what you do is you figure out what's your schedule going to be on each payment. Each payment has a certain amount of principal and interest that you pay. Okay, so they'll schedule it so that in 30 years it will be paid off completely. Okay, and then you can get fixed rate loans, 15-year, you get a 10-year, 20-year, 25-year, 30-year fixed, you even have 40-year fixed rate loans. Okay, so your payment will go down based on how long, or up based on how what kind of amortization you have. Closing costs. So that's one of the things you have to remember too. Is that when you're saving your money right now, right? You're trying to save money for this home purchase. Always also think about closing costs, because there are closing costs involved as well. In the city of Chicago, for example, you got to pay 0.75% just to pay a transfer tax. So if you're buying a $200,000 home, you have to pay 0.75% times $200,000. It costs you $1,500 to pay the city of Chicago to transfer the title over to you. What sometimes people do though is you negotiate that in your deal. You can get a closing cost credit. A lot of times, first-time home buyers, I usually will advise them that they should look at that. It's a good idea because then you don't have to come up with all that money plus down payment, Plus you have to, get a home inspection, different things like that. So it's a good idea to do that.
Is there a cap on how much they can get back as a closing cost credit?
3% usually covers what you're going to need. It's not going to be that, is there a price range you guys are looking at? Potentially?
What's it? Kind of like normal. It's not in our price range.
That's normal. That's normal. And you'd be surprised, honestly. You'd be really surprised surprised that what you can be approved for might not be what you feel comfortable with. What you can is amazing. It's amazing that way. I see things both ways. I was telling Bert earlier. I get clients that come to me, and I just had one actually yesterday. They wanted to get this, they currently pay like $600 rent, right? And they wanted to buy this $250,000 home. I'm like, okay. Did you know that on this particular home, your payment's going to be like $1,800? Oh, really? So that was that way. But then I have these people that, I want to get a $200,000 home. They currently pay $3,000 for rent. I'm like, did you know that you could, for $3,000, you could get like a $400,000 home, So it's really good to consult somebody to see where you're at to begin with. It really is. Debt to income ratio kind of covered. Down payment, that's the amount that you contribute towards the purchase, obviously. Fixed rate mortgages remains the same rate from the day that you start all the way to the end. General mortgage points. Sometimes people are confused about what a point is. It sounds really innocent. People say, oh yeah, your rate's 3.25 with 2 points. Do you know what a point is? A point is 1% of your loan amount. So if you, basically what you're doing when you buy points or get paid for points, you're paying interest up front to get a lower rate. Usually not a good idea unless you're planning on being in that house greater than like 6-7 years. Because you usually have to pay that much interest up front to be able to, if you look at your cost savings per month on your monthly payment, it makes more sense to not pay the points usually. You don't usually advise people to pay points. So private mortgage insurance is what we talk about. So if you put less than 20% down, you'll have to pay for private mortgage insurance. Okay, so kind of the process, put in your first step that you do is you do a pre-approval. It's usually a pretty quick conversation with me. It's really important so you can decide what you can, figure out what you can afford at this point in time. It usually takes me about 10 minutes, a 10-minute conversation. I can usually get the necessary information, and then what I do is I pull credit and I run it through an underwriting system. I do it all. So when I tell you what you can afford, it'll be right on unless you lie to me. So don't lie to me. You just tell me the truth about things. And I see people. I do many applications every day. So for me, I'm just like plugging in numbers and figuring it all out. That's what I do. And then if I get you a pre-approval, what I normally do is I generate a letter, and I share that with you and with Bert or Joe. And then this letter basically says that I've talked to you guys, I've looked at your information, and I believe based on that information you can be approved for this much. So then when you go to make an offer, you're a real person. If you think about a seller selling their home and then some random person can go, yeah, I want to offer this. Everyone want to know more about that person that you've actually talked to somebody. It's really important. And the realtor. These guys are going to want to know, hey, before I spend like the next 3 days with these people, I want to make sure that they can get a loan. Because most people that I know can't go in and pay cash for a house today. It's hard to do. That's hard to do. Every once in a while, there's some cash transaction, right? 90 days. So what it's based on, what the 90 days is based on, your employment, but mostly based on the credit bureau. So your credit lasts for 90 days. So everything has an expiration date on it, and credit is 90 days. So after the 90 days, we just have to pull your new credit. I just probably update your information, like make sure you're still employed in the same place, if your income went up or down, make sure you see where your assets were, if they went up or down. I'll take all those things into consideration in the approval.
So if we aren't ready to buy necessarily in the next 90 days, but we want to know where we're at.
Good idea. You know what? Yeah, it's free. I don't charge anything for it, so it's totally free. Yeah, and then I get you a copy of your credit bureau and everything like that as well. And then that way too, because I've had people that have done that. Like you're thinking maybe 6 months from now I want to buy. It's good just for me to take a look at your credit and stuff too, in case there's a little bit of a thing that popped in there. It happens all the time. Like all of a sudden you have like this little collection, or you have a little parking ticket somewhere that hits your credit score for like 80, 90 points.